All right, let's dive right into this explainer. We're looking at the staggering rise and, honestly, the devastating fall of one of the world's most infamous startups. This isn't just a story about renting office space, you know? It's about human psychology, the raw power of a compelling narrative, and the harsh, unforgiving reality of corporate finance. It's the story of WeWork and how literally a single piece of paperwork managed to destroy an entire empire. $47 billion. Just think about that number for a second. To put that into perspective, at its absolute peak, this company was valued higher than most major airlines. It was bigger than many established global banks. It was this absolute titan of the startup world, seemingly unstoppable, and then, almost unbelievably, investors just had to stand there and watch it all completely vanish. Which brings us to the central mystery we're unpacking today. How on earth do you lose almost all of a $47 billion valuation in just 6 weeks? I mean, it wasn't because of a global recession. It wasn't some sudden overnight scandal that nobody saw coming. As we're going to see, it all came down to one single, totally routine document that acted as the trigger for a complete structural collapse. Section 1. The $47 billion illusion. Let's see how they built this giant.
So founders Adam Neumann and Miguel McKelvey started with a pretty straightforward concept back in 2010. They'd rent these large office buildings, carve them up into stylish, flexible workspaces, and then re-rent those desks to freelancers and startups. Makes sense, right? But this standard real estate play quickly morphed into hypergrowth. By 2017, the Japanese conglomerate SoftBank poured in roughly $10 billion. And by January 2019, that massive influx of cash pushed WeWork's valuation into the absolute stratosphere, $47 billion, operating in over 100 cities worldwide.
And investors, they completely bought into the immense hype, totally ignoring the structural cracks forming underneath. Masayoshi Son, the billionaire head of SoftBank, actually stood up and told a room full of people that WeWork was going to be larger than Google. I mean, wow, the enthusiasm was just blinding. They weren't looking at the math anymore. They were completely blinded by the momentum.
Section 2. Selling a movement. Because to them, this was about way more than just office space.
The pitch Neumann gave was absolutely mesmerizing. See, he wasn't selling office space at all. He was selling a movement. He called WeWork a physical social network, and their mission statement literally talked about elevating the world's consciousness. All of this, by the way, while they were fundamentally just renting desks at a massive financial loss. But they had beer taps in the hallways, mandatory community events, the whole shebang. Investors weren't just buying a business model. They were totally swept up by Neumann's personal charisma and this incredibly grand vision for humanity.
But if you look at the actual mechanics behind the curtain, it basically boiled down to real estate arbitrage. WeWork was signing these enormous long-term leases on buildings. That meant they were locked into paying massive fixed costs for years. Then they turn around and re-rent that exact same space on a short-term month-to-month basis to their tenants. They were betting, hoping really, that demand would always outpace those fixed costs. But as you can probably guess, this core business mechanism is incredibly risky. Because of this model, WeWork was secretly losing billions of dollars every single year at a massive, massive scale.
Which brings us to Section 3, the fatal document, the S-1 prospectus.
Now, that document is called an S-1 prospectus. For a company valued at $47 billion, this filing was supposed to be just a mere formality, right? Just check in a box before a triumphant march to the stock market. But instead of a celebration, this required document exposed the deeply flawed foundation of the entire company. The second it became public, it essentially turned into a real-time public autopsy of the business.
The S-1 revealed a staggering volume of conflicts of interest that investors were finally seeing in black and white. The document showed, for starters, that WeWork had never actually turned a profit, but honestly, even worse was Neumann's behavior. Get this, he had personally trademarked the word "we" and, incredibly, sold the rights back to his own company for nearly $6 million. I mean, you can't make this stuff up. He also took out massive personal loans against his company's stock, and he held special voting shares that gave him dictatorial control that reportedly could even extend to his family after his death. The sheer lack of institutional checks was breathtaking.
Once that S-1 cracked the door open, the floodgates just broke. The myth fractured entirely. Journalists started digging in, and stories quickly surfaced about Neumann's highly erratic behavior. We're talking about flying on private jets that were later found to contain marijuana, leading mandatory company sing-alongs, and running a management style built almost entirely on personal charisma rather than any actual semblance of financial discipline. Wall Street, which had been so eager for this massive IPO, started rapidly backing away in real time.
Section 4. The myth collapses. Welcome to public market reality.
This whole fiasco exposes the dangerous gap between two very different financial worlds. You see, private markets can exist in a bubble. They're often fueled by compelling stories, charismatic founders, and a relentless growth-at-all-costs mentality. Private investors will absolutely overlook massive losses if the story is good enough. But public markets? That's a different beast. They are driven by math, rigorous scrutiny, and cold, hard financial statements. When the balance sheet doesn't add up, the public market will brutally and swiftly punish a company.
The pressure just became too much. On September 24, 2019, under intense heat from his own board, Adam Neumann stepped down as CEO. But, and this is the kicker, he didn't exactly leave empty-handed. He walked away with a staggering exit package reportedly worth around $1.7 billion. Meanwhile, the IPO was shelved and thousands of everyday WeWork employees were subsequently laid off.
The visceral freefall here was unprecedented. Think about it. In January 2019, they were at $47 billion. By March 2020, after SoftBank had to frantically step in with a rescue deal amidst the pandemic, the valuation plummeted to just $2.9 billion. Now, they did eventually go public in October 2021 through a SPAC merger at a roughly $9 billion valuation, but obviously that was just a tiny fraction of their former glory.
And despite continuing as a public entity, those heavy losses were simply too much to outrun. The grim reality finally culminated in a November 2023 Chapter 11 bankruptcy filing. Their listed debts were roughly $18.65 billion, far, far outweighing their assets of about $15 billion. The math ultimately caught up with the myth.
But you know, WeWork didn't die entirely. It just finally had to face reality. Following that November 2023 bankruptcy, the company actually emerged in June 2024 under new ownership, led by real estate veteran John Santora. By exiting roughly 170 leases and shedding more than $4 billion in debt, WeWork fundamentally transformed. Looking ahead to 2025 and 2026, it's no longer chasing that crazy $47 billion tech company dream. Instead, it's operating as a smaller, grounded, and much steadier company focused on, well, actual profitability.
Section 5, Math over Myth. Let's get into the ultimate takeaway here. It really all comes down to this one core truth. A valuation built on a story instead of a solid balance sheet will eventually pop. It's guaranteed. You can avoid reality for a decade in a private bubble, completely fueled by venture capital and charismatic promises. But the very moment you expose that flimsy structure to the public market, it only takes 6 weeks for the illusion to completely shatter.
So, as we wrap up this explainer, here is the essential question you've got to ask yourself. The next time you see a charismatic founder promising to change the world, elevate consciousness, or completely disrupt a traditional industry, look past the pitch. Don't just ask how big the vision is. Ask yourself, does the math actually work? Because as WeWork spectacularly proved, you can disrupt an industry all you want, but you can never, ever disrupt gravity. Thanks for joining me for this explainer. Keep learning, and I'll catch you in the next one.